someone that needs no introduction, the chairman of New York Investment Sales, Bob Knakal.
Thanks, Chad, and welcome everybody. So I'm going to talk about the multifamily market tonight a lot, but I wanted to talk about the broader market generally, just to give you a backdrop on what's going on. And the first slide I'm going to show is this one, which has a lot of stuff up there, but it's one of my favorites, and it basically shows that the market is cyclical. This is from 1984 to 2016, the Manhattan turnover rate. The blue bars are the turnover rate out of the total stock of 27,649 buildings south of 96th Street. And you see there are peaks and valleys, and the light blue lines are either major tax code changes or recessions. And you see the market is cyclical. Nobody ever said it's not cyclical. It is cyclical, always has been, always will be. So where are we in the market and where are we headed? Let's take a look at where the current market is. And the thing that's been amazing about the broader market is that 2014 and 2015 were the two best back-to-back years we had ever seen in building sales. I've been doing this 32 years. 14 and 15 were absolutely the best. In 2015, it's $75.5 billion of investment sales activity. So far this year, in the first quarter, we've had $14.1 billion. That's at an annualized rate of about 56. If we continue on that pace, sales will be about 25% lower in dollar volume this year than last. If we look at the number of properties or the dollar volume, you see an unprecedented level of number of years in a row, which really blows away on a quarterly basis what we saw in 2006 and 2007. You'll notice that spike in the fourth quarter of 2012 at $19.5 billion. Tax policy impacts the market very significantly. If we look at number of properties sold, I love 2014, 5,536 properties sold that year. That was an all-time record in the city by more than 10%. So we had an all-time record in the number of properties sold in 2014, all-time dollar volume record in 2015, two great years. And if we look on a quarterly basis, you see, again, a fantastic period going back to the fourth quarter of 2013 of sales volume in the city. And if you look at the average price of all properties sold citywide, we're running at about $11.7 million so far this year, down from last year, but that's because we have lower dollar volume. Dollar volume's on pace to be down 25%. The number of properties sold on pace to be down 7%. Those are two things that we fully expected because of the cyclical nature of the market. You can't have two record years back to back and expect things are just going to continue to go. They have to revert back towards the long-term means, and that's exactly where we are. If we look at cap rates, we see cap rates in 2016 are continuing to contract, but they are contracting at a slower pace. They are starting to plateau. And when we talk about the multifamily market, you're going to see the same dynamics happening where we still have cap rate compression, but yet cap rates and gross rent multiples are starting to moderate. If we look at average cap rate by market, here are the 5 major geographical markets that we look at: Manhattan, Northern Manhattan, Brooklyn, Queens, and the Bronx. And in fact, I'm going to be talking about the broader market in general from a multifamily perspective, and then look at the Manhattan market. And Rob Shapiro is going to talk about the Northern Manhattan and Bronx markets, and Stephen will talk about Queens and Brooklyn. If we look at average prices, when we get to values, average prices citywide have eclipsed $500 a square foot for the first time in history, at $518. If we disaggregate that into Manhattan versus the outer boroughs, you see the difference. Manhattan so far this year is running at an all-time peak, almost $1,500 per square foot. And in the outer boroughs, we're up to $379 as an average. Again, these are all-time records in terms of value per square foot. So where is the market headed? I get asked this question all the time. Where are we going with this market? Is the market turning? Is it not turning? Values are still going up, but they're going up at a decreasing rate. Volume is falling. So to answer the question where the market is headed, we really need to take a look at different product types, because different types of product are behaving differently. At the beginning of any correction in the market, and that's what people are afraid of, that the market is going to change, values are going to drop, are we going to go into a recession, what's going to happen? Land and hotels are the two product types that will correct first. land, because land is indicative of the way developers perceive the market to be 3 years from now or 4 years from now, when the property that they're buying will actually come to market in the form of office space or retail space, residential, apartments, condominiums. And hotels, because in hotels your leases are only for 1 day, so they're highly reactive to changes in the marketplace. And what we've seen so far is within the past 6 months, land values in Manhattan are down 20 to 25%, and cap rates in the hotel sector are up 150 to 200 basis points. So those two product types are really taking their lumps. Multifamily properties and office properties are still doing very, very well. And retail assets are somewhere in the middle. Retail properties are still selling for the same price they always had been selling for, or what they were selling for at the peak of the market, but there are fewer buyers for those retail assets, which is indicative of a market that's about to shift. So let's look at office. Office is doing very well, which, if this is a correction, if what we're seeing in land and hotels is indicative of a quintessential correction in the marketplace, then what we're seeing in the office market is a little strange, because office usually would be a little weak by now. But we've had over 700,000 jobs created in New York City in the past 6 years. That is enhancing the underlying fundamentals of the market very, very significantly. So office is doing better than it probably should be doing if this is indeed the beginning of a correction. So multifamily is always the last sector to turn when the market changes. Rent regulation has a lot to do with that, because it creates an artificial floor on rents. With rents being artificially low, there's less downside. So multifamily is always the last sector to go, but that leads to the question of, well, let's take a look at the multifamily sector, and is that indicative of a market that's changing or not? And what I always say to people is, since in 1998, I was very confused in terms of where the market was going, and so were a lot of my clients. We were 5 years into a correction in the marketplace. Values seemed to be very, very high. And a number of my clients in 98 said, you know what, I'm not buying anymore. Prices are crazy. Same thing people are saying today. And the people who said, in 98, prices are too high, I'm going to sit on the sidelines and wait for the market to correct again, they'd be waiting for 7 years or 9 years before the market would correct. So if those dynamics, if the dynamics of land falling and hotels hurting, if those things are a tip-off that the market is going to change, then you would say, well, if markets behave the way they always have, that is a very normal thing. Market should shift. But things aren't working the way they are supposed to work. U.S. debt gets downgraded in April of 2011. Interest rates are supposed to rise, right? They drop like a stone. The government has quadrupled the money supply in the country. Inflation's supposed to be rampant. There's no inflation. So where's the market going? I have no idea. I'll give you some statistics and we can talk about that.